Welcome everyone to Global FX Radio's webinar series. I'm your host, Andrew Spanton. October the 5th, 2008. Today we're going to be discussing moving averages, why they're so useful, how to use them, and once again, in my opinion, there is no one indicator that is the holy grail. I think you come up with your own concoction of what works for you as far as different indicators, and you stick with it. I happen to like exponential moving averages because, in my opinion, exponential moving averages, they hold true to form as to the most recent moves in the market. But to start off, what moving averages are. Moving averages are supposedly one of the most popular and easy to use tools that individuals will employ when analyzing the market. Moving averages will tend to, some might say, make it easier to spot trends. But to me, the key that what moving averages do, is it forms the building blocks of other technical indicators, such as channel lines, retracements, Fibonacci. They are all, in my opinion, interwoven together. The big difference, a lot of questions many people have regarding the difference between simple moving averages and exponential moving averages. You sort of want to think about it as far as in exponential terms. The closer you get to the I guess, current number, the more exponential it goes. Well, in better terms, it basically, simple does not take into account recent movements in the marketplace. So if you get a 200 pip move in 30 minutes and you look at the 4-hour chart, that last 4-hour bar is going to have a very more greater impact than the previous candles, especially if you've been in a tight range. So it just tends to hug and go with the market more in the moment. Obviously, the different time frames that you use are key in utilizing moving averages. The longer time frame you go, the more reliable it is. And the same thing, goes for exponential and simple. Simple moving averages might be better in the longer term than exponential is better in, let's say, the shorter term, 15-minute, hourly chart. Maybe the simple is better analyzing the weekly or the daily. But I think that in all, I like to be more in the moment, and I think that the exponential truly gives you, especially even on the daily, when you see it really rolling over, it means there's more action as of late. I think it's better to keep it simple and don't go back and forth between simple and exponential. I think you stick to one. And, the keys are the different day moving averages, obviously. But the bottom line regarding a moving average is it's the computation of the average, the mean price of a security over a specific period of time. And, they use the open, the high, the low data points, but most moving averages do use it from the closing price of the bar, of the candle, whatever that may be. And again, to me, one of the most important things in utilizing exponential moving averages or moving averages in general is it basically gives you an idea for overbought and oversold. It will tend to follow a trend. So when we look at this Euro daily chart, and you look back when the 10, 20, and 30 exponential moving averages cross to the upside, that means a change in trend. The 10 exponential is the most recent. It's over a 10-day period in this daily chart, or 10 hourly period, whatever 10 you're using. And basically, so over the last 10 days, when you see the 10 moving ahead of the 20 and the 30, that means things are heading up when the 10 is above the 20 and the 30. That the trend should start to go higher. So that might affect your bias over the course of time. And the same to the downside. So as we see here back in, the middle of February, when we started to cross to the upside and we broke out, we held. Now all of a sudden the 10 exponential is a channel line that we hold. Retracement to the 10 exponential should be bought. When the market goes into momentum phase and is hugging the 10 exponential like it does at times, bounces to the 10 exponential when it is pullbacks to the 10 exponential in this case, should be bought. When you are broken, clearly broken out, where the distance between the 10, 20, and 30 is widening. That means there's momentum to the downside, as you see here. When they're crossed and they're going back and forth is when there's choppy trading. Tends to be over the summer months, as we see. Look, in June, July, we chopped around for only a month and a half until we got really active. And then you see here again, pullbacks. The key to moving averages, okay, is the same thing. It employs Fibonacci in using it as a strategy. In a sense of, it is so important, in my opinion, when I say don't chase the market, wait for a pullback. When I say wait for a pullback, I'm talking about wait for a pullback to the 10 exponential, the 20, on the 15-minute, on the hourly. It's also like the law of averages. If something is going up, 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 and up, it's got to pull back to something, and to pull back to the 10 EMA or the 20 in itself is a formula based upon retracements and Fibonacci's. So most likely, many times when you get a move, a big bounce, and it touches the 20 or 30 or 10 exponential, it's usually a retracement, the 38, the 50, or the 61 of a shorter term chart. So many times when you get bounces, even let's say in this example right here with the euro back in August, where it bounced up to 10 EMA, it was a retracement from the breakdown to the bottom to the bounce. Many times that's the 38 or the 50. And you also can use it as going, let's say, a trend reversal. When the euro breaks above the 10 EMA, it took 30 EMA, it's probably going higher. It's a major breakout. But it employs the law of probability and statistics. And basically what it says is nothing goes up or down in a straight line, and it utilizes that methodology to help you with spots where you can look for retracements to get it with the trend. It helps you get with the trend. Moving averages. And again, it helps you not get sucked into a bounce saying, oh, now it's going to go to the moon, when in reality it's just a retracement. In my opinion, moving averages are very useful in identifying changeovers in trend, but obviously we get many fake outs. When you look back in 08, May, June, July, you had two different fake outs. We actually did in August where we finally broke to the downside, but again, notice how when you see it roll over in conjunction with macroeconomics, again, this just helps you. Another reason for your opinion, another reason for a trade. And this coincided with the whole macroeconomic meltdown in both the carry trade and the Eurozone economy in August, the subprime disaster. But again, once that 10, 20, 30 EMA crossed to the downside at the beginning of August, we never really crossed above the 10 EMA. Every time we bounced, it was the 10 EMA. And then, yes, one time we bounced up to the 20 and we pulled back again. But all of this you should be using in conjunction with other methodologies you use. Like I said, channel lines, short-term charts. All right, we can go to the euro dollar on the 15-minute chart. And see how useful it is, again, in helping us with our channel line. Notice how the euro dollar, every time it bounced through the 30 EMA, exponential moving average, on the 15-minute chart, had some sort of reversal. So you could have stuck with this trading strategy for almost 24 hours. Sorry. And it worked to perfection. It doesn't work all the time. No trading strategy works all the time. But every time it tried to break through, it failed. It had a little bit of a wick, a shooting star, a wick, a breakout, false breakout, another wick. Each time you shorted it, you could have made yourself nice pips. And once it did turn to the upside, you could have been then buying the pullbacks. So it helps you identify, well, one, look what happened here. We had a channel line that reversed. I'm going to continue this in premium. Once it reversed, notice how the 10, 20, and 30 reversed also. So the channel line in this example, on the euro dollar 15-minute chart, was busted to the upside. And then the 10, 20, and 30 confirmed it afterwards. Again, exponential moving averages, a good methodology, but no one technical trading strategy works. Use it in conjunction with others and helps you be in a high probability trade. Andrew Spanton, Global FX Radio, webinar series, Exponential Moving Averages.